Here we go. Hi, my name's Chuck Goldblum. Thanks for joining me today to learn some strategies on how to maximize the personal financial benefit from a business sale of your business. Before we get started, I want to thank American Healthcare Capital for sponsoring this event. Thank you, Jack, Jennifer, and Becky for making this possible. The plan is to present for about 15 minutes, leave plenty of time for questions if you have them, or plenty of time for you guys to have the rest of your day. And like I said, enter questions in the chat, and we can and I'll answer them if I can. All right, let's get started. All right, selling's a marathon. So I ran the marathon one and only time in my life, 20 plus years ago. I had hair, I had no children. And I will tell you, it's quite an accomplishment, but it is also really doable. Anyone can do it. I'm not an athlete. There's really just a training program. You do the training and you get the result. What I'm telling you is that your sales process, should you choose to sell your business, is a marathon as well. It's a marathon on the business sales side with the due diligence and the deal terms and all that jazz, but it's also a marathon on the personal finance side. There's so much to get right, and you can get it right. So in this program today, we're going to share you some tips and some of the steps you can take to make your sales process a success. AHC will work with you to get the best price and the best deal terms for you. And these ideas today can help you get the financial outcome that you desire when all is said and done, which is what matters, right? Now, can everyone see the slides? I just got a message here that someone doesn't see the slides. Okay, let's keep going. Someone asked about how the market for healthcare companies is going. That's healthcare and multiples. That's an AHC question. I'm not an AHC. I don't know the answer to that question. I know that they are doing a ton of business and having a lot of deals closed. So I would talk to your contact there. Well, let's keep going. All right, just quick background on me. I've got a business called Hurley Capital. We are financial consultants. We work with business owners and business sellers to do a few things. One, optimize their finances before and after a business sale across estate, tax, and investing. So you can feel like you're getting the most out of your assets at a low cost with low taxes and appropriate risk levels. The second thing we do, we help owners and sellers plan for what's next, whether it's taking care of their kids, setting up new businesses, retiring. The goal here is for clients to feel comfortable with how they're living their lives financially and going forward. And the third thing is to update and adjust these plans as the situation changes, as tax, estate, and investment situations change as well, or even the laws change. An important disclaimer before we continue, we're going to be talking about things that have to do with tax, that have to do with law, but I am not a lawyer. This is not specific accounting or legal advice. I'm not an accountant, but we have seen lots and lots of deals. We have a sense for what works. Each of your situations are unique, and it calls for unique solutions. We often work with our clients, accountants, and lawyers to help get the results you want, and also we can refer folks to accountants and lawyers. And finally, we do offer a complimentary initial consultation to all AHC clients. All right, let's get into it. So it's something weird. I'm not exactly sure. I'm getting several messages for folks who can't see the slides. Some people can see the slides. So I'm going to say to people who can't see the slides, it's you and not me, and I'm not a Zoom expert. But I am going to email these to you afterwards. But I'm going to cover anything that's useful to be covered. I'm going to cover verbally as well. So note it. Note along the way. Okay. Let's get started. All right. I would tell you that the planning process for your personal finances, it really fits in three different buckets. It's well ahead of the transaction. I'd say some say 6 months. I would say even a year or more. So if some of you folks are not close to selling yet, but plan to sell, I tune into this part. During the transaction sort of means around the LOI and during the negotiation phase, while after the transaction is what it seems, post-close. Okay, before the transaction, there's two main areas here. One is state tax avoidance for those of you in high tax states, and the second area is estate planning. These areas are intertwined somewhat, but we're going to keep this high level on the state tax side and share some concepts with you, just to sort of put ideas in your head. The first concept is moving partial ownership of the business from a high tax to a low tax or no tax state. Where possible, this allows an owner to delay or avoid state income tax on a portion of the deal proceeds. I imagine some of you might have heard the terms NING trust or DING trust, which stand for Nevada or Delaware Incomplete Gift Non-Grantor Trust. Mouthful. Well, that applies here. This concept is so widespread to help people get out of state income tax that both California and New York have disallowed this benefit for their citizens. For now, though, it still works in the other high tax states. So that's concept one. Concept two is moving the owner to a non-tax state. Now, this can be complicated depending on what type of business you have. For instance, if you're a doctor in New Jersey or a staffing business or home health network, moving likely won't help because you're providing the services in state. But if your business takes place elsewhere, like you deliver goods or services out of state, there may be something to do here. A final concept for out-of-state operators: if you live in a high tax state and do a significant amount of business in lower tax states, you may want to ask your accountant if it's possible or beneficial to file taxes in those states for related income. This could set the stage for you in some sales structures to allocate some of the gains in those states, some of the gains to those states, and avoid in-state taxes on that portion of the sale. All right, so these are just some of the ideas related to state tax. So the second area is estate planning. This is most applicable for owners and businesses that are worth probably $10, $15 million and up. So why is it important ahead of a deal? Well, as you may know, federal estate gift tax lifetime exemption limit is currently 13.6 million. It's expected to go up with inflation a bit next year. And then if the Trump tax cuts are not extended, it'll go back down to about half of that. So 13.6 for individuals, 27.2 for married couples. And you can use this exemption during your lifetime through gifts, or don't give away anything during your lifetime, and then that number is used to determine estate tax, to deduct from for estate tax thereafter. The key maneuver we're going to talk about here is maximizing the utility of the exemption by using a discounted business valuation along with a discounted business interest valuation to shift ownership out of one's estate. All right, let's go through a quick example. Hold on. Okay, so this is an example of a business that expects to sell in a year for $30 million. If you think you can sell for a year in a year for $30 million, you may be able to get a third party to appraise your business for less. Whether it's a lower multiple, whether it's different, comparing yourself to different types of companies, whatever the case may be, it may be possible to get a much lower appraised value. Then you might consider gifting to a trust maybe a minority piece of what you own. So in this scenario, what we're talking about is your $30 million business. You've marked it down via an appraisal to $20 million. And then you take 40% of it and mark that piece of it down 30% more. And that piece is now $5.6 million worth of gift. But you're going to wind up selling it in a year for $12 million. So somehow you fit $12 million through a $5.6 million hole, so to speak. To make this even better, the trust could be structured so that the grantor, in this case the business owner, is liable for the taxes on the gifted share of the company. And typically these trusts, for married couples especially, have the spouse as the trustee of the trust so that the owner can still have access to this money. And yes, in the right circumstances, this strategy can be combined with the state strategy by making this gift to a no tax state trust. All right, let's go on to the next one. So during the deal. So remember, this is about around the LOI and between the LOI and closing. Tax strategy on deal terms is very case specific. So many of these concepts will not apply to you, but one or two might. You want to make sure the lawyer representing you in your sale understands both the mergers and acquisitions process as well as tax. Remember that in your sale, price matters, but terms matter too. Your buyer is likely much more savvy than you in doing deals, so you need to be careful to get the details right. So here's some ideas that might apply to you. If you're selling a C Corp that you started after 1993, you might be able to avoid capital gains tax in a business sale. The area you'd want to do research on is something called QSBS, which refers to qualified small business stock. That's how that applies here. If you're doing an asset sale and getting paid in cash and stock, you may be able to delay taxation on the stock portion of the transaction. There's an IRS section called 721 that refers to that. If you're in a state with income tax and are doing an asset sale from a pass-through entity like an S Corp or an LLC, you should pay your state income tax associated with the business sale from your business entity. And that's in order to get the full deductibility of the state income tax from your federal income. That's the acronym for that is PTE, PTET or so. Also, as many of you know, the IRS hasn't been doing many audits lately, though that may change. At the bottom, I've written here a few strategies that I see people talking about, which I would recommend very strongly against, especially deferred sales trusts. People are recommending it, and I don't. It may not work. It reminds me of for those of you who are older, there used to be you could do anything. You could take any chances you'd like, I suppose. It reminds me there used to be this comedian, Steve Martin, the actor, what used to do stand-up, and his thing was, one of his lines was, "How do you make $1 million and not pay taxes?" So first make $1 million and then don't pay taxes. And then when the tax man comes, just say, his big line was, "Excuse me." So if you're going to do deferred sales trust, be ready to do "excuse me" when the tax man comes, because I don't think it'll stand. We could discuss the situations where it might stand, but it'll take a fair amount of work and planning well ahead of a deal. But we can talk about that as well. All right, after the deal. After your deal closes, there's a whole other set of tax considerations. They're really less related to the deal and more related to ways for you to reduce your income during the year of the deal. The most common tax delay technique is saving for retirement. Smaller business owners benefit from shifting income out of a high tax bracket during their deal year into potentially lower tax brackets when the money comes out later in retirement. If your company has a 401k, you should maximize contributions for you and other family members on payroll. If your firm doesn't have a retirement plan, you can do a personal IRA for yourself or maybe even for a spouse, $7,000 or $8,000 each. If you're a few years away from a transaction still and your business has just a few employees or it's just family, you might consider establishing a 401k plan or even a defined benefit plan, depending on your age. But that has to be done a few years ahead of a sale. The next area is charity. For those of you who are charitable now or expect to be charitable after your deal's closed, a donor advised fund is a must. Very easy to Google that and learn about that, but here's how it works. During your deal year, you can set aside money that you intend to give away to charity down the line and get a write-off for all of it, a charitable deduction for all of it during your deal year, right? And so for most sellers, your deal year is your highest tax rate, your highest income year. That's the year you want the deduction. And then you have this money set aside. There is no schedule, no requirement on when you need to distribute it, but all of your charity for the next X years will be pre-funded when your tax rate is as high as it's going to get. And better yet, if you have a brokerage account with appreciated securities in it, instead of taking cash from your deal proceeds, take some of your appreciated stock, take some of your Apple or Nvidia stock and put it in that donor advised fund. And now you don't even have to pay the cap gains on that. And you still get the additional charitable deduction. All right, on the bottom, these, what I call esoterics, these are for the people who are truly allergic to paying taxes. Opportunity zones, oil and gas partnerships. There's pros and cons to them, and we can discuss them. All right. So I like to talk about when after you've sold your business, you have a new business. Your business is your savings. You know, I'm sure all of you are pretty savvy at how do you manage tax? How do you manage costs? How do you manage everything related to your business? If you take a lot of money out of a sale and it's more than you've had in the past, you need to build those same skills as relates to your personal finance. How do you keep your taxes down? How do you invest and take less risk? How do you understand the laws that are around this and set it up to your benefit? So you need to become better at this. And especially because your financial world has changed, because your income's going way down from the business and your expenses are going up because you're not putting your personal expenses through work as much. Here are some tips. Just these are pretty obvious things that you'll think of when you're managing your own money. There's other stuff to do, and we can talk about it. But the idea simply is what you would do in your own business, right? You're maximizing income and minimizing taxes. Oh, one final thing, which I didn't mention before. When you get paid, you're going to have a bunch of taxes due. And what I would do is I'd work with your accountant to figure out what taxes you're going to owe. Take that money, set it aside, whether it's in your business because you plan on paying the state income tax out of there or partially out of the business in your own pocket. All of that money that's going to go to the government should be in treasuries right away, day one. And you should have a brokerage account set up for it to do it because, you know, $1 million at 5% is real money each day. And the idea of it is once you have that tax money set aside, put it into treasuries and make as much as you can off it until you actually have to part with it and give it to the government. So there are the tips there. Well, here's how your selling marathon is going to end. Either with you completely planned out and crushing it, or this dude who makes it but isn't pretty pleased about it. I am ready to take questions. I've hit all the bases I have. Let me see what I have here in the list. All right. Okay. Do we work on a fiduciary basis is the question. The answer is yes. And fiduciaries, for those who don't know, are we required to act in your best interest at all times, client's best interest at all times? The answer is yes. All right, next question is, when getting a valuation on your business, is there a specific type of valuation you need to get that the IRS recognizes? For example, can a business broker provide one, or must it be a CPA or lawyer, for example? Okay, so first of all, it depends. I mean, I would suppose it depends on the deal size, right? You know, $1 million deal or less, I think if your accountant is reputable, a business broker is reputable, I think, and they're following a process. I mean, there is a valuation process. There are, by the way, there are third-party valuation firms that are in the business of doing this, and they'll give you a 50-page report for, you know, depending on the size of the business, $3,000, $5,000, $10,000, that hits all the bases, right? A valuation needs to, you know, there's various different ways to value a business. One is on cash flow. One is compared to its competition, you know, and then, you know, taking into account, you know, risks, assets, liabilities, deal, and your building deal, a lot of money, et cetera, et cetera. So there's not a specific form, but there are specific approaches. So I hope that answers your question. How does a seller's note impact taxes? Well, the cool thing about a seller's note is that you're delaying income in some respect, right? So you will have the option, and this is, you would work through it with your accountant, but you may have the option to recognize taxes on when you actually receive the money. As a, you know, a $10 million sale with half of it up front, you should be able to delay taxation on half of it, which could be to your benefit, right? The more you spread it out, the better on the tax standpoint. Next question is current estate tax exemption. As I mentioned, I think it's 13.6 for individuals and 27.2 for couples. Do you not have to wait for 5 years after becoming a C Corp before that 10 million is tax exempt? Is there any way to get around that? I don't believe so. QSBS is pretty particular. And also we actually spoke to someone recently who, they also need to be original shares, right? You can't buy the C Corp and then get QSBS. You have to actually, I believe, have original shares in the C Corp. So those are some of the details there. I don't think, it's certainly 5 years on the C Corp, and there may be other deals related to that. And also the 10 million tax exemption, that's the limit. There are ways to get around that by having other shareholders. Maybe it's you and your spouse, maybe it's you and your spouse and your kids, you and your spouse and kids have trusts, and so on and so forth. Let's do a few. Where are we now on time? Okay, we've got a few minutes left. I live in a state with no income tax. My business is domiciled in a state that has income tax. Do I need to move the domicile of the business, or is that not relevant because the proceeds will come to me in the state where I live? I need to know more information to answer that question. So I'm going to skip that. If you're starting a new business with the assets from your sale, should you have the new business in place before the sale? My first impression is I don't think it matters. I don't think it matters. I mean, I suppose if it's a real estate business, there might be something there, but I don't think it matters. All right. I live in California, and my home health and hospice is in California with a current value of 10 million. May I know if there's a tax strategy so I can defer paying taxes, etc. The answer, well, let's put it this way. First of all, the two state tax strategies that we discussed in the presentation won't apply, right? You can't move, and you can't move the ownership. But there are other things to do that can help. There are, to the extent you're charitable, there's some charitable tricks to be done. And there may be some other stuff. I assume you're not a C Corp, right? So QSBS, we're working with somebody now near Sacramento who is benefiting from QSBS. But that, like I said, each situation has its own particularities that we can discuss if you'd like. Let's see. Let me take one more. I'm happy to. You have my contact info on the bottom of this slide. You can reach me, and we can talk more separately. Let me just take one more here. I have an LLC, and I'm selling the entire entity. Is there a way for me to still get that full state income tax deduction? So we actually spoke to a AHC client about this, and the answer is, if you're right up against selling, if you're selling right now, the answer is probably not. I suppose, but there is one thing you can do if you're still somewhat further away from the transaction, which is, if you think you have to sell your LLC because that has the permits or something like that, maybe you can create an LLC to hold this LLC such that you will still have an entity after selling your business. The trick is you need a business entity to hold your business so that the business entity can create that pass-through entity benefit. So I don't know if that was clear. All right. So listen, that's the end of our show. I appreciate all of you joining. I'm sorry to get to all the questions. We're up against our limit here, but I'm happy to talk to folks. Like I said, any AHC client, we're happy to give a consultation to. We see a lot of deals, and we just, I think I said it earlier, the buyers are very savvy. They do deals every day. For you, this might be your second deal, but it's likely your first deal. And there's stuff to know, and you want to know it, and you want to be taken care of. You want to have a good lawyer. So I'm happy to answer questions as best I can. I'm happy to refer you to pros who can do it better. But otherwise, thanks very much. Thanks, American Healthcare Capital. And we'll talk to you soon. Take care.